Ever felt overwhelmed by the stock market? Imagine if there was a way to invest in hundreds of companies with just one simple purchase. Well, there is. It's called an ETF, and it might just be the game changer your investment strategy needs. Welcome to the Savvy Finance Corner YouTube channel. Wealth begins with knowledge. ETFs, or exchange-traded funds, have taken the investment world by storm over the past 2 decades. Why? Because they combine the best features of stocks and mutual funds into one neat package. They're easy to trade, affordable, and give you exposure to entire markets or sectors with a single product. For long-term investors looking to build wealth, ETFs offer a flexible, transparent, and cost-effective solution. So what exactly is an ETF? Think of it as a basket filled with various securities, stocks, bonds, or even commodities. This basket is then traded on a stock exchange, just like an individual stock. Unlike mutual funds, which are priced once a day after the market closes, ETFs can be bought and sold throughout the trading day at market prices. They often come with lower expense ratios and greater transparency compared to mutual funds, making them a hit with modern investors. Now, let's dive into how ETFs work. When you buy an ETF, you're essentially purchasing shares on a stock exchange. Like the NYSE or NASDAQ, the liquidity of an ETF depends on 2 factors: the trading volume of the ETF itself and the liquidity of its underlying assets. One of the coolest things about ETFs is how their price stays so close to the value of their holdings. This is thanks to a mechanism called arbitrage, where authorized participants create or redeem ETF shares to keep the price aligned with the net asset value (NAV). ETFs come with a host of benefits that make them attractive for long-term investing. First up is diversification. With just one ETF, you can gain exposure to hundreds or even thousands of companies. It's like buying a slice of the entire market pie. Transparency is another big plus. Most ETFs publish their holdings daily, so you always know exactly what you own. Lower fees are a major draw too. ETF expense ratios are often just a fraction of what you'd pay for a mutual fund. And let's not forget about tax efficiency. ETFs are structured in a way that often reduces capital gains distributions, which can mean lower tax bills for investors. But hold on, it's not all sunshine and rainbows. ETFs do come with some risks. There's market risk. If you're invested in a stock market ETF, you'll ride the waves of overall market conditions both up and down. Sector concentration can be an issue too. If you've got an ETF focused on a specific industry like tech or energy, you might be in for a bumpy ride if that sector hits a rough patch. And then there's tracking error. Sometimes an ETF doesn't perfectly follow its index, which can lead to performance differences. ETFs come in all shapes and sizes. You've got index ETFs that track broad market indexes like the S&P 500. Sector ETFs focus on specific industries. Bond ETFs provide income and stability. International ETFs give you exposure to foreign markets. And for those looking to invest in the next big thing, there are thematic ETFs targeting specific investment themes like clean energy, AI, or ESG, environmental, social, governance. When it comes to choosing an ETF, there are several key factors to consider. Expense ratio is crucial. Lower costs mean higher returns over time. Historical performance can give you an idea of how well the ETF has tracked its index. Fund size and liquidity are important too. as larger funds usually offer better stability. You'll want to check the tracking accuracy to ensure the ETF closely follows its benchmark index. And don't forget to look at the quality of the underlying index itself. Strong. Well-constructed indexes tend to provide better long-term performance. For long-term investors, ETFs open up a world of strategic possibilities. Dollar-cost averaging DCA is a popular approach, where you invest a fixed amount regularly to reduce the risk of market timing. Diversification across different asset classes using various ETFs can help spread risk. And don't forget about rebalancing. Periodically adjusting your portfolio weights helps maintain the right risk-return balance over time. Let's talk about some popular ETFs that long-term investors love. S&P 500 ETFs like SPY or VUR are favorites, giving you exposure to the 500 largest U.S. companies. For those looking to go global, total world market ETFs like VT offer diversification across international markets. And if you're after stability and income, bond ETFs like BND or AGG can be great additions to your portfolio. These ETFs are widely used as core holdings by investors looking to build long-term wealth. In conclusion, ETFs have revolutionized the way we invest, combining simplicity, low cost, and broad market exposure. They're powerful tools for building long-term wealth, allowing investors of all experience levels to create diversified portfolios. Keep costs down and follow disciplined strategies. Whether you're just starting out or you're a seasoned pro, ETFs offer a flexible and effective path to financial growth and stability. So why not take a closer look at how ETFs could fit into your investment strategy? Your future self might just thank you for it. Remember, investing always carries risks. And it's important to do your own research or consult with a financial advisor before making any investment decisions. But with the right knowledge and approach, ETFs could be the key to unlocking your long-term financial goals. Here's to smart investing and a brighter financial future.